traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimer, and there's a couple of those to look through. I'll just run through some of the key, two key objectives really of the webinar. The first really is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way in the box, and I'll hopefully answer those as soon as possible, or at least after the webinar finishes. Secondly, we do think markets are generally driven by themes, so we look to highlight these in the next 30 minutes or so, based on fundamental ideas, of course, and then allied to looking at the technical moves in markets, be that in currencies, stocks, or commodities generally. So just letting you read the rest of this disclaimer. And I'll just run through what we hope to get through then in the next 30 minutes or so. We'll first just check out how markets are trading currently, especially after, of course, the TV debate, the first, probably the only presidential TV debate actually in the US, obviously between Vice President Harris and Trump last night. We'll just check out how markets are receiving that. We'll then look at or review last week's main events, which were really the non-farm payrolls data, of course. Also, we had the Bank of Canada meeting, so we'll look at the dollar against the CAD, and we'll look at some of the other currencies before then previewing this week's main events, of course, US CPI in a few hours' time, and then tomorrow's ECB meeting as well. So we'll look at the dollar index, we'll look at euro dollar, and just a few charts and graphics as well to help you hopefully understand what is to come in the next 24 hours or so. Okay, markets currently, European stocks pretty much in the green. Just checking and giving you a chart here. US futures, yeah, dipping slightly, really on those odds shifting in favor of Vice President Harris at the moment. We'll just go into that in a little bit more detail shortly, but otherwise markets really, currencies at the moment, the dollar is lower, and European currencies moderately benefiting from Harris really being perceived as the debate winner. Big currency move is in the yen. That's outperforming really after a Bank of Japan policymaker, Nakagawa. He stated that the central bank will proceed with its rate hikes if inflation aligns with forecasts, and really indicating that last month's market turmoil, you remember at the start of August, that first Monday, and that turmoil, that hasn't now altered their plans. This also follows actually from comments recently as well from another policy board member. He last week, Takata, he emphasized the need to stay on course with rate hikes, while of course treading carefully to kind of avoid volatile markets harming businesses. That potentially seems to be out of the way now. So you can just see, I've got the chart here actually of dollar yen, and we're really now just broken down through that August spike low at 141.68 there. We're just trading on it now, actually having dipped, you can see, down to 140.70. So we're just back to that spike level, whether that offers resistance or this is just another spike and we just hold up here. You can just see we were very oversold on that spike, of course, on the daily RSI. And again, we're not that oversold at the moment just yet after pulling back, of course. So really key level for us is long-term Fibonacci retracement level here. If I just pull this back slightly, this is from those lows in 2023 up to that high of this year, just below 162, of course. And you can just see it's a major Fibonacci level, 61.8. Retracement level at 140.48, tallies with this cycle low here from December, and we're just sort of around that number now. So really interesting level here, whether we get some support or not as we move into next week, actually in the BOJ. Then again, levels below here, potentially you've got these small levels here, 138.05, and then that level from July last year at 137.23 potentially, but a major level of support here in our minds in dollar yen. Other markets also attracting attention. Commodities, certainly, with crude oil slump really yesterday. We don't look at oil that much, but really this is a decent chart to check out, we think, because you can just see again just the big move down, the big break of this dotted line, major level there at 72.47. This is Brent crude, and we just sort of moved down then below these other previous lows. And if I just pull it back now, we're back down to sort of December 21 levels, which is sort of 65, 67 or so. So yeah, oil, something that is grabbing people's attention. For Brent, then the first time below $70 for, well, in 2 years that you can see here. WTI as well dropped to a December 2021 low. Really, there's warnings now that this oversupplied market potentially takes market or prices, sorry, back into this sort of mid 60s level or so. Demand is being questioned really at a time of quite robust and expanding supplies. OPEC Plus kind of struggling as well with their response and really an inability to predict demand. And that's been clearly on display after really the group held on to its 2024 demand growth forecast of more than 2 million barrels per day. And that's more than double what the EIA forecast in its outlook. So quite interesting goings on here in the oil market. And then that plays into certainly headline inflation, not core inflation, of course, because that strips out energy components and the price of oil, for example, but certainly headline, the headline impact will be noticeable with this move down in oil. Key then for us, I mean, you've got 72.47, but also then this level here from March 2023 last year at $70 or so, just above that. So we're not quite, well, we've dipped below there that you can see, but we're back above that 70 level. So just keep that in mind for then the wider impact on potentially inflation going forward. As for that debate, we should get into that. Obviously, Donald Trump, Kamala Harris, yeah, debated for 90 minutes yesterday. You probably saw it, everyone. Key issues, including abortion rights, immigration policy, of course, and then the economy. Probably unlike the first debate, of course, where there was that clearly defeated Biden in many ways, a knockout win, really. Markets kind of awarding Harris the victory on points at the moment. I think a CNN poll that showed 63% of voters thought Harris won the debate. And then betting odds, which move around all the time, are seeing Trump's chances of winning the election back below 50%. Markets, well, they kind of might want to probably see new opinion polls in the next few days to take more decisive positions. But at the moment, it's seen as dollar negative, really, if Harris is gaining the ascendancy and potentially has more chance of obviously getting the winning vote and getting into the White House. Potentially then this keeps a lid, as I say, on the dollar and then prompts a sort of more favorable environment for currencies with basically a high beta, if you like, to protectionism and geopolitical issues. So European currencies are benefiting. And then also stock futures, as I've mentioned, slightly in the red, pointing to less chance of a Trump 2.0 victory, really. And then also assets like Bitcoin are lower as well. Trump seen as a supporter of cryptos, of course. Energy stocks, again, sort of as a sort of more in detail example, they may face headwinds as well. Market sentiment adjusting to the sort of shift in political dynamics. And many of the other Trump trades as well, such as, say, a weaker Chinese yuan or traction in defense stocks, they could take a backseat again if Harris is seen as gaining momentum. Flip side, I guess, is the Harris trade, and that is kind of challenging to price in, really given the complexities of the Senate potentially limiting the prospects of a Democratic clean sweep. And a split Congress really would mean kind of restrained fiscal spending, potentially then keeping the risk of a recession alive for next year. but then also possibly seeing more Fed rate cuts. Just all things to bear in mind, obviously, post that debate, really interesting debate if you watched it or just watch the highlights and take your own view, but that's kind of what markets are thinking, we think, at the moment. As for stocks, we always like to get onto stocks, of course, first. We just pull up a couple of charts, the S&P 500, first of all. Here, let's just blow that up a bit. Yesterday's session, well, ended with small gains for the S&P. The Dow slipped, actually, really due to quite big declines in banking stocks. So JP Morgan, that dropped over 5% after lowering its 2025 net interest income forecast. Goldman's, that fell over 4%, 4.4% down following weak trading revenue projections. But then flip side was tech stocks did offer some support. Kind of mega cap tech stocks up 1 to 2% or so, and that drove the Nasdaq up just under 1% on the day. Oracle shares, they jumped 11.5% after beating earnings estimates and securing a deal actually with AWS, Amazon Web Services, that is. But Apple dipped a small amount, 0.3%, I think, after losing a court case over its $14 billion tax dispute in Ireland. As for stocks generally then, from last week, they suffered actually their worst week in more than a year, really on obviously weak economic data, the non-farm payrolls data, and then cautious commentary from some of the central bankers stoking kind of some concerns over a sort of bigger possible economic slowdown. The S&P, that drops 1.7% Friday. That brought its loss to 4.2% actually, so the worst weekly drop since March 2023. You can just see that on the weekly chart here, the big red candle there. And if we just look at this firstly on a technical basis, again, we've got Fibonacci levels in here of this down move from those all-time highs down to that early August low. And we're just around, we just bounced off the halfway point of that move. That's at 53.94. You can see hopefully there. And we've got the blue line, which is the 50-day moving average, just coming up to that at 55.05. And then we've got a minor fib level at 55.51 before then that all-time high at 56.69. In the Nasdaq, large tech stocks, they have been particularly bad hit recently, especially last week. Nasdaq actually suffered its biggest weekly fall since January 2022, dropping nearly 6%, 5.8% actually, after a 2.6% drop on Friday. Again, if I pull up the weekly chart, you can see the red candle there. And then on the daily, we have dropped through the halfway point of this sell-off. So a bigger sell-off than the wider S&P, just through the 38.2, that's at 18,679, and we're just hanging around that now. The halfway point just above 19,000, and then the 50-day moving average just above that at 19,365. This black line here, just for your guide, is the 200-day moving average actually, so that's below here at 18,157. Just looking at the Dow, similarly, these moves, again, that's held up much better than the Nasdaq, less tech stocks, of course, more defensive utility type stocks in here. So we're just sort of dipped below the 38.2 of this move and at 44.06 with the all-time high close at 41,585. Okay, let's now get to a review really of last week's main events. Again, please do ask any questions along the way and I'll try and answer those. But yes, main event last week, of course, non-farm payrolls, the US monthly employment data, just running through that. So the headline, of course, 142,000 versus a sort of 165 or so consensus. So a slight downside miss. Unemployment, that ticked down 1/10 as expected to 4.2. Though interestingly, actually, if you look at the rounded number, it was 4.22% versus 4.25% previously. Earnings, they rose 10th actually to 0.4% above the expected 0.3. The annual rate of 3.8 versus an expected 3.7 and previously 3.6. Probably big issue for us was the revisions to the headline. So 86,000 are downward revisions to the past 2 months. We've put that in there. And really now we're seeing consistent downward revisions to the data. And that doesn't, again, even include the provisional benchmark revisions released a few weeks back, if you remember, that showed the BLS, so the Bureau who coordinates all the data, they've overestimated payrolls growth by an average of 78,000 per month in the 12 months to March 2024. So if you think about that, for example, then June was initially reported at 206, revised to 179 last month, and now is just 118, 118,000. And then July, looking closer to home, that was revised down from 114,000 originally printing to 89,000 this time. And then again, watch a possible revision in the release next month. So just something to bear in mind, we think. And given that, well, the headline numbers certainly are sort of slightly, some economists sort of not fully trusting those headline numbers now, really. And that means kind of, do we need to knock off, say, 78,000 off the headline figure to take account of this sort of error in the BLS model? That would then give payrolls growth on this number of just 64,000. So yeah, something to bear in mind. But otherwise, in any event, the report, well, key in determining, of course, the size of the rate cut that we get from the Fed next week. After some sort of volatility, really quite a bit of intraday volatility after the NFP release, markets kind of sided with a 25 basis point cut. I've got in here sort of 75% chance. That is sort of a few hours after the data, with then a sort of 25% chance of a 50 basis point jumbo cut, if you like. Ultimately, the data kind of confirmed weakness in July, kind of not an aberration, but rather really a sort of part of a softening trend in the labor market, gradual softening trend at the moment. Job growth has slowed to rates kind of usually seen only around recessions, and then does suggest potentially the unemployment rate will rise and possibly accelerate higher. We did get comments, we should say, after the release as well from a couple of Fed speakers, noting, of course, that we're now in the blackout period of Fed speakers 10 days before the Fed meeting. We don't hear from any Fed officials, but as I say, immediately after the release, we did get to hear from, well, New York Fed President Williams. He acknowledged it is time to cut rates. And then we also heard from Fed Governor Waller. He stated he could support consecutive cuts or even larger ones if the data warranted it. And then Chicago Fed President Goolsbee, he said he basically advocated, or he has advocated for actually rate cuts for months now, and basically emphasized the data-driven approach to policy decisions. One other thing to note, we think after non-farms was the Fed's whisperer. Possibly we might hear from him this week, because as I say, it's the blackout period for officials. That is Nick Timiraos, who works at the Wall Street Journal. Basically, he tweeted after the NFP that the headline figures weren't bad enough to make 50 the base case, but in light of the revisions, it wasn't good enough to convincingly and cleanly kind of douse speculation on a larger cut. So that's the NFP, really. We've got a chart as well, which just shows you the 3-month average, that orange line. So certainly going in one direction now. And then you've got these benchmark revisions as well, which are something to bear in mind, we think, possibly going forward with this data. Just other data as well from last week, briefly, we had those ISM PMI surveys, so manufacturing and services. Manufacturing did rise a touch, but still remains below 50. That is a sort of expansion contraction line. And then services, that had a small rise, actually very small, to 51.5 from 51.4, so above the 50 line. But looking at some of the components, employment did fall to 50.2, so very close to that level. But then prices paid and new orders actually lifted. So the report continued really to highlight that some sections of the US economy continue to be resilient. Okay, the main event last week, from last week as well, was the Bank of Canada meeting, and I'll just pull up, just bear with me, the dollar CAD currency here. But yeah, the Bank of Canada, they did reduce their policy rate for the third consecutive meeting by 25 basis points, taking rates to 4.25% as expected, really. Q2 growth has been slightly stronger than forecast, but other indicators suggest recent activity has been soft. So the labor market is slowing. Wage growth, remains elevated, but that's relative to sort of productivity growth, whereas inflation, including underlying measures, has declined further to actually in July 2.5%, and that really allowed for further easing. Interesting, at the press conference, Governor Macklem, he still advocated a data-dependent approach, but he also then kept the option open for bigger rate cut steps going forward. And certainly you kind of think now, with inflation getting closer to target, the Bank of Canada probably needs to increasingly guard against the risk that the economy potentially is too weak and then inflation falls too much. The market, just checking that out actually now, currently fully discounts 2 more additional 25 basis point cuts at the October and December meetings, and there's around a sort of 30% plus chance of actually a bigger move as well. So that's a picture for CAD really, and you've just seen really after the sort of fall from that spike high at the start of August, 139.46, then dropping down below 137.40. 134.70, that we did, and then we just seen this bid that was mainly down to dollar weakness, of course, and then we've just seen the dollar sort of assert a bit of strength, with the loonie then suffering from potentially more rate cuts to come. Yeah, you can see that long-term fib level again around 134.71, I think. Just decent level of support. We dipped down below there as well on Friday after MSP, but then quickly retraced really and finished on the highs of the day and the week. So that was a bullish sign. We're now approaching the, just through, yesterday we went through that black line, which is the 200-day moving average of 135.88, but we're just back below that with this dollar weakness now. So initial level of support, potentially that long-term halfway point of this move, that's a 135.61, and as I say, the 200-day moving average bang on pretty much where we are now, 135.88. Upside level otherwise just above 136 or 136.52 is that next fib level. That's the retracement level with the blue line. That's the 50-day moving average at 136.48. Okay, let's get on to now the main events just before I get to that, actually, we'll just remind you of some of the UK data which has come out this week. So we've had a labour market report yesterday, pretty mixed actually. And just bear with me 1 second while I pull up cable. So that's sterling against the dollar, of course. I'll just pull up that chart for you. So yeah, labour market data, always interesting, important for the Bank of England's. Most important number though really is wage growth, not really a jobless rate, because there is reliability issues really about that unemployment number and the poor quality of the data in the survey really. So markets and economists I know are certainly taking the unemployment rate with a pinch of salt. But the wage growth certainly is important. That was lower than expected at 4%, below the consensus 4.1. with last month's figure revised up actually, and then the less volatile wage number is actually the ex bonus number. That came in as expected at 5.1%. That's the key number for policymakers. Jobless rate did tick down to 4.1% as expected, just for your guide. But again, we stress the sort of poor quality data of those numbers. But yeah, it's the wage growth numbers still relatively elevated, really 5.1%, that ex bonus number. And probably that means, of course, that those gains above 5% still too rich to be compatible with the Bank of England's inflation target, and really then precluding any rate cut from the Bank of England next week. I think there's around a sort of 16% chance, maybe a bit higher, 18% chance, about 4 basis points or so of easing priced in to next week's meeting. So a non-negligible but very small chance of a rate cut by the Bank of England next week. So for cable, we've seen a decent run actually, and we did get GDP numbers out today, kind of slightly dented the sort of UK exceptionalism sort of picture that has been painted recently, certainly above the Eurozone, and the UK being slightly in a better position growth-wise on account of course, political stability after the election, and then just better figures that we've seen recently. Slightly dented with those GDP figures today, but otherwise, cable, yeah, relatively strong, certainly against the dollar. I think the only major up against the dollar on the year as a whole. You can see we've got some fib levels in here from that April low up to last month's high. So resistance at 132.66, sort of 61 region. And first level of support is a minor fib level at 130.37, tallies with that high in July at 130.44 or so. So that's a region of support. If we do lose that, then you've got the 50-day moving average at 129.47. That's that blue line, and then the next major fib level really for us at 128.95. Okay, now let's move on to this week's main events. And of course, firstly, we do get US CPI data, and I'll just pull up a chart here with that on firstly, and I just want to double check you can see that now. You can. So yes, that's out obviously in a few hours time only. Consensus looks for a rise of 0.2% month on month in August, previously 0.2, and then the core rate, that's the key number again, excludes kind of volatile food and energy prices. That's expected to rise as well, 0.2%. So pretty steady from previous month. And then the year on year expected to rise 3.2%, I think, for the core. I should have said the headline year on year expected to fall to 2.6 from 2.9%, I think, from memory, and that would be the lowest print since 2021. Just in some detail, shelter inflation, that is forecast to slow in August after some surprising strength really in rent in July. And then the Fed does look at the sort of super core numbers, so that's core services ex shelter. Don't want to get too much into this, but that could be a touch stronger in August compared to July, although the upside risk in categories like airfares does not feed into the Fed's favored inflation gauge, which is the PCE number. Really, we think then a steady report is expected, 0.2%. That's what we need, 0.17% over a number of months to hit the Fed's target. So yeah, another print of that nature, and just remember the rounding really that some in the market do look at, so 0.2 but rounded sort of 0.17, 0.18, that type of number, rather than a 0.22 number type thing. Just check that out as well, potentially for the move. But a steady report, certainly likely to cement a 25 basis point rate cut next week. Although we do have retail sales actually next week as well to navigate. But this is the last inflation report, certainly, of the Fed's dual mandate, if you like. We've had the job numbers, of course, on Friday. Now this inflation report. Again, speaking after that jobs data, actually, Williams, he did say jobs market was better balanced, but was not the main source of inflation. He sees inflation, just for your guide, at 2.25% this year versus the Fed's June forecast of 2.6%. Although, of course, that forecast is stale and will be updated next week when we get, of course, the fresh updated summary of economic projections and, of course, the members' dot plots. Yeah, so that's CPI really, and really a steady report again cements a 25 basis point cut for us. If we just look at the dollar index, which is of course an index of the dollar against 6 of its main trading partners, the euro having by far the biggest weighting in this index. Don't forget that. Around 56% or so of this index. So if you flipped this chart in a way, it would be the euro dollar chart. We'll look at the euro dollar very soon when we look at the ECB announcement. But you can just see this, DXY falling down to key level of support, 161. That is, that was the late December low from last year. So we bounced off that level. We bounced off it again. During the non-farm payroll sort of release and volatility around that number. I've put in here sort of descending channel, so just a series of lower lows, lower highs, and we just sort of popped out of that, and so may not be relevant as such now, and it's certainly, we're sort of dipping lower now, but certainly 161 is a huge level for us. It has eased those oversold conditions you can see there, so potentially we're going to look to that again. Otherwise, resistance looks like, yeah, near-term Fibonacci retracement level at 101.88, which capped the upside you can see at the start of this month. Okay, let's finally get to the ECB meeting that is out. Obviously, they sit down and release their rate decision tomorrow. Just bear with me 1 second and I'll pull up firstly a graphic. Hopefully these graphics are of use to you guys, and here's the preview here with kind of the main numbers that we look at, probably officials look at as well, hopefully. ECB certainly expected to cut rates by 25 basis points again. That takes the depot rate to 3.5%. If you remember, of course, they started the easing process in June, then they skipped July, and after that, then they placed the emphasis on September for the next policy move. Conviction really for a cut has come from, well, the ongoing progress in inflation, the easing of wage pressures as well, and that is seen in the Q2 negotiated wage survey, and then downbeat growth outlooks really for much of the block. I've just put in here then the headline number, obviously in inflation 2.2% now, but really services inflation and core inflation as well. Core inflation is at 2.8%, so still somewhat above the 2.2% target. And then we've got this issue which is sort of prevalent for most central banks, services inflation, to do with wages, of course, which is in the Eurozone highest since October 2023 at 4.2%. So that is sort of really getting the hawks on the governing council, getting their notice, and sort of they are concerned about that. As such, really the focus for this meeting probably will be, or certainly is actually, on any guidance towards the next cut after the one we see at this meeting. We do get fresh economic growth and inflation staff projections as well, and they could be interesting, certainly with the sort of inflation levels for 2025 and 2026. Otherwise, they should probably be broadly unchanged, possibly growth forecast coming down, possibly a slight down revision, as I say, to the inflation forecast for 2025 especially. That is on the back of lower oil prices that we sort of highlighted as well as then this stronger euro that we've been seeing. Obviously, any downward revision to growth or inflation would then increase the likelihood of a more rapid pace of rate cuts, while flip side, of course, upward revisions would then motivate the hawks to slow down further rate cuts and then certainly underpin support for the euro. There has been ECB really like this. They like leaking out some sources, stories they're called really, and we've seen one in Reuters actually, which outlined really the decisions are expected to be more complicated after September, with the debate being over how weak growth and potential recession will impact the inflation outlook. Interestingly, that piece actually concluded that the ECB will provide no commitment around October. However, the Doves do want Lagarde, President Lagarde, that is, to signal that back-to-back moves are not excluded. So interesting battle really between the Doves and the Hawks, you would imagine, on the Governing Council over any guidance at all being offered, or whether more likely we think Lagarde remains cautious, highlights data dependence, going from meeting to meeting. Those are kind of the watchwords we think will be key. That is inflation in the Eurozone, just to highlight that as well. So a chart just showing you the fall, of course, moving towards the 2% target, but then just slowing up slightly in the core, even though it dropped to 2.8%, but still sticky and held up with services inflation, as I've said. Let's just wrap up with looking at the euro dollar then. Just bear with me while I pull up that chart, which is here. So again, you can see the sort of flip side mirror image of, in a way, the DXY chart partially, if you get my drift. And I just want to make sure you can see that euro dollar chart, which you should be able to see. But yeah, just running through those levels in euro dollar then ahead of the ECB meeting. So again, we've drawn a Fibonacci level, and we just passed that minor one at 110.62. Just found a bit of support just below there. But the next fib level for us just below 110, so that's a 109.74. The 50-day moving average is at 109.63, and then you've got sort of resistance, well, big resistance around 112, and then we've still got on here the high from late December, that's at 111.39. Okay, I'll wrap it up there, I think. Don't have any questions at the moment. So yeah, really do appreciate you being on the call. We actually have another webinar next week as well. So not bi-weekly, as I said at the top of the webinar, but another one next week, which is due to certainly the big risk events we have, of course, next week. Just to emphasize that, the Fed obviously on Wednesday, so we'll preview that. We also have the Bank of England on Thursday, we'll preview that, and also the Bank of Japan, I believe. So we'll look at, again, cable, we'll look at dollar yen as well. And yeah, a major preview of those risk events, as well as reviewing what happened in the ECB tomorrow and that US CPI data as well. Thank you so much for listening in, and I shall speak to you very soon. Take care.